Hello and welcome to another 30-Minute Thursday. My name is Amit. It is 2 p.m. in the beautiful and glorious spring-like Pacific Northwest. If you could see the windows behind me, sun is just streaming in from all sides of my house, at least. Yes, I'm broadcasting once again from home. I am working from home this afternoon. And in any event, welcome. I'm still trying to adjust my screen, but I think, knock on wood, I think I have got this technology thing somewhat figured out. I hope it continues to roll in this good way, but so far so good. And we are just going to continue with that good energy, and fingers crossed that I will continue to learn more technology along the way. As you know, I'm analog, but everybody can learn, even me. That said, I apologize in advance. I turned off my team notifications, but there's a seminar going on or a webinar or whatever through Teams, and everybody who's participating in that is chiming in, thanking the folks who presented for their time and their service. And even though I turned it off, I'm still getting those notifications, which hopefully y'all are not seeing or hearing, but it's a little bit frustrating. It's kind of like one of those reply all things to emails. I don't know how it works. I don't know why people do it, and I don't know how to make it stop, but it's part of the frustrations of the modern era. If this is the worst thing we experience, we're doing really good. All right, so let's talk about things we are experiencing that are not really good right now. And one of those things, unfortunately, is the Federal Reserve. Wait, before I say all that, let me step back and welcome everybody properly. I apologize. Where are my manners? I hope everybody is doing great. I hope you guys are staying safe, staying healthy, staying sane. Very important to stay sane in an otherwise insane world. And that's not a knock on anyone or anything, but I hope everyone's doing great. And thank you so much for spending a little bit of time with me on Facebook this afternoon. So going back to where I was headed, the Federal Reserve Board, bless their hearts, they just keep on doing things that are really frustrating. And what's frustrating about it is that they claim to be data-driven. Data-driven, that's what the Fed is saying right now, which means that, you know, they're looking at all of these economic reports and using the information from these reports to make their next sort of decision about how to deal with the economy, how to deal with inflation, how to deal with all of these other issues that you and I and everybody else is really experiencing. And there's a squeeze going on. I don't know if you squeeze. There you go, squeeze. So that's what the Fed is saying, that we are data driven. We're going to look at these reports, at these economic indicators, and so on and so forth. But the fact of the matter is, they're not looking very closely at this information. And if they are looking at this information, they're certainly not doing a very good job of extrapolating data from the information, because they are doing what we refer to as driving in the rear view mirror. What that means really is that if we're driving down the road this way, the windshield is in front of us, and we want to pay attention to where we're going, right? When we talk about driving in the rear view mirror, it means that you're looking at the rear view mirror up there and trying to figure out where you've been while you're going in the opposite direction, while you're going forward. And that seems to be what the Fed is doing. They're looking at economic data that is old. It's always old. So for example, tomorrow we're going to get the PCE report. That's the Personal Consumption Expenditure Report for the month of March. And that is the Fed's favorite measure of inflation, is this particular report, the PCE. Whatever, we can talk about the validity of that, or it doesn't really matter. The point that I'm saying right now is that it's for information from March. Well, gosh, we're just about to hit May. So you're looking backward at what happened, and you're setting policy in May going forward. And in May, they're expected, May 3rd is when they're meeting again, and they're expected to raise the short-term interest rates by yet another 25 basis points, or 1/4%. So that would take the prime rate to somewhere around 8.25, 8.25%. And that's important. The prime rate is what the banks charge their best customers. The prime customers are getting the prime rate, and the prime rate is at 8.25, or will be at 8.25 after May 3rd. Right now it's at 8%. So still, that's what they treat their best customers. How do they treat their worst customers? I don't even want to think about it, but it's not good. And so the Fed continues to look in the rearview mirror as they set policy going forward. And that's a very frustrating thing. The thing is that we are expecting inflation to come down. The powers that be, even the media intelligentsia and the other economists that are not 100% great at this part of their job. I don't know everything they do, guys. It's not my place sitting here in my home to tell these economists and these government prognosticators and so on and so forth that they're doing a terrible job, even though in my heart of hearts, I can feel that they're not doing a great job. They've got a lot of other stuff that they're dealing with. So I give them a little bit of grace and a tiny bit of slack. But that said, they do not understand all of the components of the economy that go into the reports that create the data that they are claiming they're using to support their actions. So they're saying all these things, a lot of words, but they're not really being very wise about how they're getting the information and how they're interpreting the information and how they're extrapolating the information to go forward, not to go backward. To use a metaphor or an analogy, it's an analogy, not a metaphor, to use an analogy, and I'm going to borrow this from one of the guys I subscribe to. His name is Barry Habib, very, very smart guy. He talked about Wayne Gretzky, the hockey player, who arguably is probably the best hockey player that ever skated, maybe even one of the better athletes that ever played any sport. But Wayne Gretzky in an interview said, hey, what I do is I don't skate to where the puck is, I skate to where I believe the puck is going to be. The same thing, linebackers in football said the same thing. They go to where the ball will be, not to where the ball is. And the Fed should do the same thing. They should go to where the inflation will be, not where the inflation or the data is. But they're not doing that. They're in fact going not just to where the data is, that would be bad enough. They're going to where the data was, which is even worse, man. So they're missing it by a long, big stretch. They should be going to where the data will be, but they're not going to do that. And that means that they're going to cause more problems, and they're going to cause more pain, and they're going to cause more economic turmoil. And we're all going to be feeling that. We're all going to feel more and more of that pressure. And so what I posted earlier today when I was talking about or promoting my Facebook Live for this afternoon is these rates, as the Fed keeps pushing them up. So the Fed, the prime rate right now is 8%. It's going to be 8.25% as of May, and as of late June, which is the next Fed meeting, it's probably going to be 8.5%. That is a lot. That's significant. What that means to you and me and the consumer class is that if you've got a home equity line of credit, as an example, that interest rate that you're paying, making payments based on, adjusts every time the prime rate goes up. So when the prime rate goes up by another 25 basis points, 0.25%, your payment is going to go up by an interest rate is going to go up by another 0.25%. So the way HELOCs, home equity line of credit, works, usually, I can't say every time, but most every time, the way the home equity line of credit works is the lending institution takes a margin which is fixed for the life of that loan. That margin is going to be 0.5%, 1%, 2%. It depends on a lot of variables. It depends on your credit score. It depends on the loan amount. It depends on your combined loan to value of the second mortgage, which is what the HELOC is, plus your first mortgage. It depends on a bunch of variety of, once again, depends on a bunch of variables. And I will talk with you about variables in just a moment because there's something else I want to cover here. But they take the margin, and once that margin is calculated, it's fixed for the life of the HELOC. So that's the good news. So whether it's 0.5% or 1% or 2%, whatever the margin ends up being, that's fixed for the life of your HELOC. But the index is not. The index is variable, and the index plus the margin equals the fully indexed rate, or basically the interest rate on which your payments are calculated. So if your margin is 2%, as an example, and the prime rate right now is 8%, the prime rate is the index that the banks use for calculating HELOC payments. So your fully indexed rate, 8% on the prime rate, 2% on the margin, add those together, your fully indexed rate is 10%. And your interest payments are calculated based on 10%. When the Fed raises interest rates again in May, the prime rate goes from 8% to 8.25%. Your fully indexed rate goes from 10% in this example to 10.25% in this example. So every time the Fed increases those interest rates, your home equity line of credit interest rate will go up as well. And your payments, by extension, will also go up. The same thing can be said about your credit cards. So if you're carrying a credit card balance right now, every time the Fed raises those interest rates, your credit card interest rate will go up by the same amount that the Fed increases their rates. And the credit card rates, they're not 8% where the prime rate is right now. They're like 18% or 20% or 24% or some horrific number. Like, look, I don't want to make light of any of this. I'm fortunate enough to be in a position where we pay our credit card bills off at the end of the cycle every month. So I don't carry a balance, which means that they don't get interest from me. That's great, good for me, and I'm not taking a victory lap because I know that a lot of people don't have that opportunity, and for that, I'm really I feel for you guys, because this is really expensive money now. Like, this is loan shark money almost. And so what I want to talk to you about is, how do we get out from under the payments that y'all are being forced to make as the Fed continues to squeeze on people? And the way I want to do that for you guys is by talking about cash out refinancing your current mortgage. So if you own a home and you've got an interest rate, I don't care what that interest rate is. Let's say it's 3% on a 30-year fixed. That's a great interest rate. Good for you guys. Hopefully you got that from me. If you didn't, that's okay. Whoever put that in place for and with you, they did a heck of a job. Great. Okay, but here's the deal. You're getting crushed on your credit card payments right now. You're getting crushed on your home equity line of credit payments right now, if you have one of those things out there. If you're making those payments, I want to talk with you about the idea of doing a debt consolidation, cash out refinance by using the equity that's in your current home to pay off those higher bills for your credit cards and your home equity line of credit. And I know what you're going to say, and I understand completely. The pushback on that is, dude, I got a 3% 30-year fixed rate mortgage. That's like gold. That's like the trophy on the mantle. I don't want to get rid of that and go into a 6.5% or 7% or even 7.25% interest rate on all my bills. That's just crazy. Why would I do that? I totally get it. But the reason you would do that, or the reason we should talk about doing that, is because I want to talk about cash flow and monthly expenses, not interest rates. The interest rate is great. Look, I love my low interest rate. I love the low interest rates. I arranged for as many of my clients as I could before they stopped the music and rates went up. I love that stuff. And yeah, it is a point of pride. It's a point of pride for me as well as a professional. But you know what's really more important than pride? Paying your bills on time. What's more important than pride is easing the burden that a lot of people are feeling because their monthly payments have skyrocketed, because their HELOC interest rates have more than doubled, because their credit card interest rates are astronomical, and because the Fed keeps cranking these rates up, making it very difficult for people to make ends meet. So I want to get past the idea of, hey, I got to hold on to this low interest rate, like with both hands, like it's the last money I'm ever going to see. I want to get past that mentality with you guys. And I want to talk about certain situations and circumstances, how we can roll all of your current credit card debts and your home equity line of credit debt into a new 30-year fixed rate mortgage. Yes, the payment on the mortgage is going to be more expensive. No question about it. You're going from 3%. I'm just going to throw a horrible number out there. You're going from 3% to 7%. Okay, wow, that's a big, big difference. And that may in fact be, not may in fact, that will in fact be a higher monthly mortgage payment. But when we look at the cash flow from what you're spending on your credit card balances and your home equity line of credit payments, when we take all of those payments and we eliminate them, we bring those balances to zero, and you no longer have to make those monthly payments, and you clear the deck of all of that debt, and you roll it all into one mortgage payment. That, yes, that will be more expensive, clearly, in the short term, especially. What does the difference look like? Can you save money, big picture, every month by getting rid of this consumer debt and absorbing it all in your mortgage? If you can, and if it makes sense to do that, I highly recommend that you speak with me, or that you speak with your mortgage lender, whoever that may be. It should be me, but if it's not me, I'll get over it. But you should speak to someone and find out what that calculation looks like, because you may save hundreds, if not thousands of dollars, even though it's counterintuitive, but you may save hundreds of dollars every month on your total cash flow out, on your total expenses, on your mortgage, your credit card payments, your home equity line of credit payments. We may be able to save you hundreds, if not thousands of dollars. And that matters a lot. That matters a whole lot more than telling your neighbors, I got a 3% interest rate on a 30-year fixed, but you're going under because the credit card debts are up to here and they're just squeezing you too much. So I want to get past interest rates and talk about actual cash flow and actual savings. Let's talk about that. And keep in mind, in a year, in 8 months, in 18 months, somewhere in that span of time, the Fed, despite all their goofiness, will get a handle on inflation. And when inflation comes down, guess what? Mortgage interest rates are going to come down too. And then we could do another refinance and bring that interest rate back down. Will it come back down to 3? I don't know. I tend to doubt it. But will it be somewhere at 5, 4.5, 5.25? Maybe, probably, possibly. And if it is, it's still going to be a big savings from 6 or 7, where you would be right now if we did this cash out refinance. The point that I'm making, guys, is that that interest rate, that 3% interest rate, that looks great on paper. That sounds great up here. It may make you feel really warm and fuzzy in here. I'm patting on my chest if you can't see the video. But what it doesn't do is solve your immediate problems. And I want to talk about solutions, because I know people are starting to really feel the crunch of what the Fed is doing to us. And they're going to continue to do that. The Fed will continue to do this until something breaks. And then they're going to take a look and say, well, now that we've broken the economy and that we've popped whatever bubble and we've stomped on everybody, now we're in a place where we can let it ride and see what happens from here. But they will continue to do this because this is their MO. This is their modus operandi. I'm not going to blame the individual members of the Federal Reserve Board and the decision makers. They carry their own culpability and their own blame. But as an institution, and looking at it historically, I know that this is what they do. This is what they've always done. Why would they change course now? So I urge you guys to please call me. If you're carrying credit card debt right now, if you're trying to figure out how do I get out from under these expenses, if you've got a home equity line of credit right now and the payments keep going up every month, call me, please. Let's talk about a solution. I know it's counterintuitive. I know everyone wants to hold on to this low 30-year fixed rate that we arranged. I get it. But if you're struggling with your bills, it doesn't matter what your interest rate is. All that matters is that you get past the immediate problem. When I teach Krav Maga, which is something I love to do, those of you that know me offline or that you follow my Facebook stuff, you know, my motto is we like to close loans and crack bones. The crack bones part is from Krav Maga. And Krav Maga, one of the #1 principles behind this self-defense technique, or this self-defense system, excuse me, is that we have to address the immediate threat first. And the immediate threat for you guys right now may very well be that these credit card payments, this home equity line of credit payment, these other variable interest rate payments that you are dealing with are choking you. with expenses. So when someone's choking you, they got their hands around your throat, you got to clear your airway first, excuse me. You got to clear your airway first and foremost. If you don't, you're going to be choked unconscious and even worse. So all the other fancy stuff is irrelevant if you can't breathe. And the same thing here, that 3% 30-year fixed mortgage that you've got sounds great to boast to your neighbors. But if you can't breathe, if the bills are just stacking up on top of you and just crushing you, then what's the point? It's irrelevant. So I want y'all to give me a call or call your mortgage professional, whoever that might be, should be me. If they're not already telling you about this, and they're not already talking to you guys about this, then it should definitely be me, because what are they doing for you? Talk to somebody, see, let's do the math, let's do a payment calculation, and let's see how much money could be saved monthly. Maybe it'll work, maybe it won't work, but the consultation is free. So what harm would it do to talk about that? Okay, moving on. I've got 8 minutes left. I want to touch on something here that I mentioned. You might be seeing this in the news. You might be seeing this on your social media feed. You might be learning about this from some weird other source. Let me do a share screen here because I have technology skills now. So I'm going to use them and I'm going to share my screen with you. Okay, this chart right here, let me bring it up a little bit. Okay, this chart is going to be, it's complicated. I've got 8 minutes. I'm going to give you a top line view of what's coming next in the mortgage field starting May 1st. This is coming to everyone equally. No bank, no lender, no individual, no company. None of us is exempt from this. If you sell loans to Fannie Mae and Freddie Mac, and everybody sells loans to Fannie Mae and Freddie Mac, this is going to be the new reality. And what it does basically is it shifts interest rates and points. It shifts interest rates and points, and the people who were considered top tier clients because they have really good interest rates and a really big down payment, they're going to start paying more for purchase transactions than clients that have less than great credit and significantly lower interest rates. Fannie Mae and Freddie Mac is instituting this change across the board. Now, remember, when I spoke with you earlier today about the margin that is set on home equity line of credit, remember, that's what the bank adds to your interest rate based on a variety of factors. Your credit score being one of them, the loan amount being another one, the combined loan to value, the second mortgage plus the first mortgage divided by the value of the home in general. That's the combined loan to value ratio. All of those things are factors that lenders use to create their interest rate environment. In the Fannie Mae, Freddie Mac world, we refer to that as an LLPA, a loan level pricing adjustment. The higher the LLPA, the more the points or the higher the rate. I'm going to try to be I'm going to try to explain this as much as I can, but basically when someone says, well, what is the interest rate? Well, it depends on your credit score. It depends on the type of property that you're going to buy, a single family home versus a high-rise condo. It depends on the purpose of the loan. Is it a primary residence that you're financing, or are you financing an investment home? All of those things have an impact on what's known as the LLPA, the loan level pricing adjustment. And as things change, the points or the cost for the interest rate is going to change, or the interest rate itself is going to go higher. So if you say, well, look, I don't want to pay any points. I don't want to pay any additional fees out of pocket for my interest rate. And so we look at a 0-point loan, the interest rate is going to be higher than what a loan with 1 point or 2 points would be. Okay, so I'm trying to do this as best I can for folks that are not in the world of mortgage interest rates. Historically speaking, guys, the higher your credit and the bigger your down payment, the lower your interest rate was. And back in the day, as of today, even up until May 1st, the top tier credit score for just about every lending institution for first mortgages was 740. Anything above 740 was just icing on the cake. It didn't do anything for you on your interest rates, but it was something, again, bragging rights between people who are on the same loan, looking at, well, I got an 801 credit score and you've got a 798 credit score. It doesn't matter. It was the same, anything above 740. Now, Fannie Mae and Freddie Mac have said that 740 to 759 is not the top tier anymore. In fact, neither is 760 or 779. Now, top tier credit is 780 or higher. So when you have top tier credit, even if it's 780, you should get the very best interest rate, right? Well, no longer, because now what Fannie and Freddie have said is that they want to make it easier for people who have lower credit scores and lower down payments to buy homes. And the way they feel they can do that is by lowering the interest rates offered to these particular buyers based on the loan level pricing adjustments. So if you look across this board here and you say, okay, so here's someone that's got a 95% or higher loan to value, meaning they're only bringing in 5% down payment, and look at the credit score here, less than or equal to 739, their interest rate or the cost for that interest rate is going to improve by 1.75%. That does not mean that their interest rate will be 1.75% lower. It just means that the cost for that interest rate, the points associated in the background for that interest rate, will be 1.75% lower than they were today. By contrast, someone who has a 740 credit score and an 80% loan to value or a 20% down payment. Historically, this was considered top tier. Now their points are going to increase by 0.375%. So the cost of their money for people that have a 740 credit score and a 20% down payment, historically known as the top tier or higher tier loan clients, their cost of money is going to go up. Now, they can either pay this 0.375% out of pocket, that would be looked at as points, so 0.375% of the loan amount, one-time fee, or it can be absorbed by the interest rate, in which case the interest rate would go higher. Not higher by 0.375%, but certainly not as low as it was before these changes are coming along. So if you look right here, these folks, 740 to 759 credit score, slightly higher than 20% down payment, they're going to pay the most. And by paying the most here, it's going to make it more affordable for Fannie Mae and Freddie Mac to extend credit to these clients over here who have a credit score of 640 or lower and a down payment of 5% or less. And that is coming out on May 1st. None of us is exempt from it. Anyone who wants to sell loans to Fannie Mae and Freddie Mac, and that's everybody, is going to be dealing with the same thing here. This is political. It is financial. I am not in the business of doing political commentary on why Fannie and Freddie are doing what they're doing. So I'm going to leave that to the political commentators. I just want to make y'all aware of this. So if you see it on social media, if you hear people talking about it, if you if you're in the market shopping for a home and all of a sudden your loan officer tells you, hey, the rates have changed because you haven't locked in your interest rate yet, you haven't found a home yet, and now what we talked about last week, next week it's going to be different. And I want you to understand why that is. This is not my policy. It's not my company's policy. It's not the policy of any other company either. I don't think there's anybody's happy about this except for the powers that be at Fannie Mae and Freddie Mac, and they have reasons that they are doing this. So more on that later on. Hopefully they will reverse course on this sooner rather than later. Hopefully the Fed will reverse course on this sooner rather than later. But since this is my last 30-minute Thursday before the change goes into effect, I felt compelled to share this with you guys so you're not caught off guard and think that I'm snoozing at the wheel. I'm well aware of what's going on here. Unfortunately, there's not a darn thing I can do about it. Getting mad won't help us, so we might as well just move forward and deal with what we can work with. And what we can work with, going back to what I started this conversation on, is let's talk honestly about consolidating your debts. Let's talk honestly about how much every month you're spending on your credit cards if you can't pay your balances off at the end of the cycle. Let's talk how much you're spending on your home equity line of credit if you have one of those. Let's talk about these two things and other bills that are starting to pile up and starting to make you feel like you're choking on the payments. Let's find a solution. Don't insist on holding on to this low 30-year fixed rate interest and then have all your money going out the back door anyway, because your credit card payments and your home equity line of credit payments keep going up because the Fed keeps cranking the interest rates up. We have a solution. It may fit your needs. It may not. Call me up. You know where to find me. Let's talk about it and let's see if we could put something together for you. Until then, have a wonderful, wonderful week. Have a fantastic weekend. It's beautiful in Seattle this weekend. If you're in the Pacific Northwest, get outside, get some of that sunshine. It's good for us. It's healthy for us. One point, next week, I will be traveling for a friend's bachelor party. Those of you who know. So I will not be here. We'll have to catch up the following week. But until then, please call me, email me, DM me on Facebook, however you guys want to reach me. Let's talk. Let's find some solutions. That said, thank you so much for spending 30 minutes with me. It's a little bit more than 30 minutes, but I hope you guys picked up some valuable information. Thank you again for spending some time. Stay safe, stay healthy, stay sane, and I will see you not next week, but the week after. Y'all take care. Bye-bye.